like these things need to be securities at the end of the day. I'm not going to like go into the specifics of the funds, but a lot of these funds have made money from having L1s trade at really high valuations, then come down to reality, but they realize the DPI. And so like providing clarity for commodities from their perspective is beneficial. But ultimately, besides BTC, ETH, Sol, etc., like it's not clear that anything's or any of these things have value. And I still think like the jury is out on what is the value of BTC, ETH, Sol.
Hey guys, Blockworks Digital Asset Summit is going to be back in New York City, March 24th through the 26th. We're going to have top speakers from leading asset managers, financial institutions, DeFi protocols, crypto companies, policymakers, you name it, everybody all under one roof. Think BlackRock, the SEC, Tether, Robinhood, Solana, and much, much more. Follow the link in today's show notes to get your tickets, and you can use code Lightspeed200 for $200 off at checkout. Nothing said on Lightspeed is a recommendation to buy or sell any investments or products. This podcast is for informational purposes only, and the views expressed by anyone on the show are solely their opinions, not financial advice or necessarily the views of Blockworks. Our hosts, guests, and the Blockworks team may hold positions in the companies, funds, or projects discussed. Hey guys, welcome back to another episode of the Lightspeed podcast. Today I'm joined by my trusty frequent co-host on the Lightspeed Roundups, Carlos from the research team. And we've also got Noah from Theia on today as well. Really glad to have him join us. I know, Noah, we've had you over on the 0x Research podcast from time to time, but maybe not on Lightspeed so recently, or at least with any regular cadence. So glad to have you on today as well. How you guys doing today?
Glad to be here. Yeah, it's my first time on Lightspeed. Happy to join.
Yeah, doing great as well, Danny.
Awesome. Well, the Noah, we love you in the 0x Research Telegram group for a lot of the, I think, conversation starters that you bring to that chat, largely around, I mean, there is this big debate that's been ongoing, I would say, for the past maybe year and a half, 2 years now, around token models, like token holder protections, this variety of different things. You know, we've talked about MetaDAO and various other, like, you know, paths to success for tokens and token holders on this show. But it's still a big topic. And recently, or I guess yesterday now, I think the SEC released some guidance specifically on classifications of digital assets, which I think the industry has known that this has been coming for some time. We've gotten like little bits here and there. About a year ago now, we got some clarification around what were called sort of like digital collectibles. And that kind of was applied broadly to like meme coins, NFTs, things of that nature, classifying them as non-securities. So it was sort of like, you know, a hall pass, like go ahead and trade these things. Like we don't care. We're not going to, you know, sue you for launching a meme coin or an NFT. Since then, there's been work on stablecoins, but this more recent guidance is a bit more like, I guess, holistic in the sense that it lines out a bunch of these categories and says that now we've got digital commodities specifically, which are not securities. And I'll just give a quick explainer what they say. They say that digital commodities are crypto assets that are intrinsically linked to and derive their value from the programmatic operation of a system that is functional, as well as maybe supply and demand dynamics, rather than from the expectation of profits or managerial efforts of others. And then the other big one that they call out, obviously, is digital securities. So obviously, this lineation between digital commodities and digital securities is a big functional piece of this. And so that is described as financial instruments enumerated in the definition of a security that is formatted or represented by a crypto asset, with the record of ownership is maintained in whole or in part on or through one or more crypto networks. So basically saying it's a security, but it exists on or is represented on some kind of crypto network or ledger. Whereas digital commodity is basically describing it as not a security, saying that the way that this thing operates is not, you know, it's not based on the efforts of others. It's the way that it operates is entirely, you know, basically defined by code, if you want to call it that. And it kind of exists and persists based on that nature. I think this still leaves maybe some gray area, and this is kind of the path dependency of this. Our industry has kind of been a result of this, where it's like, okay, we need to wait till mainnet before we launch the token, and then we need to distribute a certain amount of the supply to participants through like an airdrop or something that's like maybe kind of akin to a sale, but effectively so that like the team doesn't own all of the tokens, so that we can have this semblance that this asset that we're launching is not a security and maybe more closely resembles a commodity. I think we've gone through quite a bit of that now, and it seems more recently people are more open to the idea that maybe not everything will necessarily fall into that bucket. There are certainly things that are more security like and certainly things that are more commodity like, but maybe to open up the discussion, like just around this guidance that they've released and sort of the conversations we've had for a while. I'm curious what you guys think. Like, we've gone a few years now through this like kind of rigmarole with agencies and the SEC, sort of like, what are they going to say about crypto tokens versus like how do we feel about certain types of tokens and their designs. I don't know, when you look at the what are now classified as digital commodities, like the ETHs, the Sols, even the XRPs, and I think Dogecoin and some of these other things like kind of fit into that bucket now and have been called out explicitly, versus what might be something more like a digital security. Does it have you feeling any certain way, like either it makes sense, it doesn't make sense, or expect more or less success coming from kind of the commodity side of things or the security side of things?
So I'll share a few points, but naturally I spent a lot of time thinking about it, given it's existential for Theia's business. I think that at a high level, things are trending in the right direction from a regulatory perspective, but um, and this guidance has, I would say, de-risked the commodities and like non-particularly valuable tokens, um, but has made the valuable tokens still in this like relatively ambiguous period. Like I could see where the puck is going as far as like there are additional headlines from regulatory agencies around reducing reporting requirements and scaling it as a function of the size of a firm. Um, and so I imagine that there will be a clear path to registering as a security, having your token trade on chain. Um, but there are going to be some trade offs to doing so. Like there will be a reg tech layer that needs to be built out. That's always been obvious. I just think the industry has generally avoided it because KYC is something that they've been allergic to. But I think that's partially a function of the market opportunity that opens up from KYC has historically not been that large, and the existing market opportunity of non-KYC participants has been sufficiently large, but that pendulum is swinging. And so I think it's a fine change that is going to happen, but ultimately these are probably the next steps. Um, but yeah, I think it's good that BTC ETH, all these like commodity tokens that trade based on supply and demand as opposed to like having security natures are kind of delineated as commodities. But that's the extent of the regulation that I've come away thinking, okay, this is now a definitive stance, whereas everything else still has more to go. Um, and like the other thing that I'll add is that I think the funds that and just in general the like people that are lobbying for crypto um within the government have generally not, I think, accepted the truth about this industry with regards to how their funds are making money. Like these things need to be securities at the end of the day. Like a lot of I'm not going to like go into the specifics of the funds, but a lot of these funds have made money from having L1s trade at really high valuations, then come down to reality, but they realize the DPI. And so like they get in this mindset of, oh, like utility tokens, like ownership economy, all these different ideas that I think obfuscate how value is created, and like over index to the past. And so providing clarity for commodities from their perspective is beneficial because it's a lot of what their funds are investing in, or in the case of Coinbase, it's a lot of the tokens that are listed on their platform. But ultimately, besides BTC, ETH, Sol, etc., like it's not clear that anything's or any of these things have value. And I still think like the jury is out on what is the value of BTC, ETH, Sol. Don't get me wrong. I'm long mentally on some of those assets, but the point is that like they don't have defined valuation frameworks. And so I am mildly concerned that the people lobbying on behalf of crypto believe that tokens generally fit more towards the commodity box, and they can maintain a certain valuation that like justifies these funds and platforms' existences. But I think what they'll realize is that increasingly the value that's being created within this industry is from companies that are structured more as equities as opposed to kind of commodity tokens. So I'll stop there, but that's kind of my high level on what I see going on in Washington D.C.
Yeah, to be honest, I completely agree with that. Like, we kind of knew that BTC, ETH, and Sol were designated as commodities. That's why they were approved for US spot ETFs, like when they were. And I do agree that like the incentive from here on out is, if you can designate your token as a commodity, it's probably a lot easier than having to go through all the burdens of having to like register it as a security and all the process that goes into it. But I do agree that if the majority of value kind of keeps accruing to the application layer and to like this equity like structures, then it's probably like the most valuable tokens going forward will have like kind of this security like functionality, regardless of the of like what happens going forward. I think like yesterday's like SEC or CFTC announcement was good in the sense that it added clear rules of the game, which is something that we've lacked for a long time, and it's good to see like regulatory clarity continuing to evolve in the US, which kind of um, can attract more like builders or prevent some of the builders like from leaving or from going for like obscures like token equity structures or things like that. So I do think like one of the best points for me is just like the regulatory clarity and the clear rules of the game that we can expect like in the next few months.
Yeah, I think a lot of these points make sense. I think when you highlight this like undercurrent that's maybe difficult to describe in some ways, but around people thinking this digital commodity kind of nature of assets is something that can persist and be valuable. It's interesting that within the definition that the SEC provided here, they say specifically um, assets that are linked to and derive their value from the operation of a system rather than from the expectation of profits, which is like an interesting call out there. Obviously, there's more reference maybe to just the efforts of others generating those profits, but like when we look at some of the what you would maybe call more successful token models today, like people would probably reference Hyperliquid. You might even reference Pump and say that they're directing 100% of or nearly 100% of the kind of on-chain revenues to the token. And maybe that is some like kind of gray area way to say that kind of the team acting behind that on-chain revenue layer is like not somehow, you know, deriving a ton of value for this business effectively. Um, but I do think, like you mentioned, it opens up questions of like, will teams be able to continue to kind of ride this line and at some point fit into a spot where they can become this digital commodity, or are they? Is there some point where we have to kind of accept the truth that like a lot of these things are still effectively securities in their nature, and there may be some risk perhaps just due to the kind of additional regulation that will have to come for them.
I mean, the key test for me is like, can the network or protocol function without the token? And for BTC, ETH, and Sol, like all three tokens have very clear like functions in the network, if that makes sense. So for ETH, you need it like for gas fees, and you need to stake ETH for to be a validator, etc. For Sol, kind of like the same thing. For BTC, you need to like mine Bitcoin, and it is just traded based on supply and demand dynamics. For like things like Hyperliquid or Pump, like sure, the token has been kind of relevant, but if you remove the token entirely, the business will function exactly the same way, in my opinion. So I think that's kind of one way to look at it, where like if you remove the token, like ask yourself if the protocol will function the same way. For a lot of these protocols, the answer is kind of yes. And so I think the purpose of the token is kind of having like this value accrual layer, and like it's a security by that definition, in my opinion.
Yeah, I feel like the thing that I've been most concerned about for our business is just kind of creating regulations that force teams to try to justify that their tokens are commodities and create complicated mechanisms that ultimately damage their businesses as a byproduct of trying to fit within this regulatory bucket. And even before the current administration, I've always had qualms with token models because they've all had to play this game. Like, we're all aware of like these, you know, staking, lockup, whatever it is, like these are ultimately games that have no value for businesses. So I am concerned that teams are going to like do what DYDX did with like launching a blockchain to say that we're actually like an L1 and therefore we can drive value to validators, but essentially it's just passing through earnings as dividends. So I think that would be a bad outcome, forcing teams to make product trade-offs in order to fit within a certain regulatory standard. And so my view for how most teams should operate once there is a bit more clarity on the security side is probably to register as securities. Um, I think there are many reasons why companies stay private. Like the cost to being public is, if you IPO, you're generally going to lose 4 to 7% of or IPO proceeds to your underwriter, and then there's a few $1 million of legal fees to get registered, and then a few $1 million of annual costs. And so those are prohibitive for small companies. But ultimately, if you have regulatory that limits the amount of disclosure you have to provide, then those costs come down. In which case, there's more of a reason to go public. And so I think our industry would be well suited to build the underlying infrastructure necessary to allow for securities to trade within the market. Um, and like one example that I'll give you is I think that like money market protocols, so like Aave, Camino, Morpho, have historically taken the permissionless peer pool model approach, where you used to have kind of a pool of a number of different assets that generally are not securities and people can borrow stables against them. And generally, they've been reticent to add securities into these pools because then you need a regulatory technology layer on top. Um, but ultimately, that is probably where the market is going to go. And you see that with, for example, Superstate on Camino, where if you want to like move the underlying tokenized equity into another wallet, both those wallets need to be whitelisted at the Superstate level. And so I'm sure these problems will be solved, but I think that we have to be like honest with ourselves about how to create value and what is beneficial for the industry in the long term versus kind of how can we hack our way to not having to deal with regulations. Um, so that's kind of my view of the market right now is that I think it can go in the right direction, but I also think that historically we've had to play games as an industry, and I'd prefer to move on from those games.
I guess I'm just curious, Noah, what for you, what would be like this ideal direction? And like what do you think ideal regulation like looks like going forward that would allow these teams to stop playing these games?
I think that you need to allow for companies to go public via a more lightweight um, uplisting function. And so I don't know what the reg standard is. Like you can go through the traditional exchange listing routes like NYC and NASDAQ, in which case there's a specific classification and disclosure framework that you have to meet, or you can go through like OTC markets, various frameworks that they have for their markets, which are like lower disclosure requirements, lower cost to list, but ultimately meet what the government is looking for. And historically, the reason why people have not gone to the OTC market is just because there are less market participants in that market. And so you're generally going to have a lower valuation and low liquidity. And so like there's value to being listed on the NYC and NASDAQ. But ultimately, these are like what I would consider a regime built on regulatory capture, whereas for tokenized securities that trade on blockchains, there isn't this idea of like an exchange of relevance. Ultimately, there's a security standard of relevance that can fit across many different types of exchanges and blockchains. And so, yeah, I'm just arguing that for growth stage businesses, there's a path to tokenize their equity, go public, fit within a disclosure regime that has a max cost that is not overly prohibitive for sub $1 billion companies. And I'm not sure exactly how we plan to KYC composability, because I see that as being an issue, not just in crypto, but just in general. But like that's the next thing that has to be solved after you kind of build this immediate layer. Because when you build this layer, eventually you'll have some companies go public via superstate, some companies go public via another platform. Then you got a mess of standards, and both on the legal side as well as the tokenization side. And then if one ledger is being kept by superstate and another is being kept by another company, how do these ledgers interact with each other? I think it opens up a bunch of questions, but ultimately this is the direction that I think I'd prefer the market go into, and try to figure out how to make these like trade-offs that come after you create this layer work. So I don't know if that's like too vague, but that's generally my view of the direction that the market should go to.
I like the takeaway. I think in like it's almost maybe lucky that there is this kind of open question or debate around public private markets for traditional equities as well right now that might end up being beneficial to like crypto securities or digital asset securities as well, in the sense that some of these things that you mentioned, like, I don't know, we're seeing the current administration way lower minimum reporting requirements for public entities, which, you know, may be good for some reasons, may be bad for others. But I think maybe the one hurdle that like broadly the public markets have today is that there's kind of just like this flat line, which I think you effectively described, of like, if you want to go public, you better be making at least some, you know, some high watermark of money today as a business to be able to afford the reporting, the lawyers, the consistent, you know, annual disclosures and other requirements. And there's not necessarily like a stepped way of approaching that today, where you could be a much smaller company but be effectively public and maybe just have a much lower bar of disclosure requirements. But then as you grow, you know, you're a $1 billion company, you're a $10 billion company, whatever it needs to be, those requirements could kind of grow as your business grows. Like the requirements that you have to fulfill as a public entity sort of scale as the size of the business scales. That might be hard to like codify in the laws, or, you know, maybe it would just require more diligence to kind of update what those requirements are. Like, you know, we update what the tax brackets are on a regular like annual basis and revise those numbers upwards, typically based on, you know, inflation or other factors. And so I don't know, it wouldn't be crazy to potentially follow that same approach for this private public approach. And you could see that being beneficial for, you know, if you're raising, you know, $50,000 to do a small online startup, there should probably be a small number of things to disclose, but it's not like, you know, you need to be doing intense quarterly reporting. It's like you're either going to be successful or fail within 12 months. So it's like we could have a very low level of requirement for, you know, new startups, and we could have a much higher level of requirements for a business that makes, you know, $10 billion in profits a year. And that's something that I think the financial or the, you know, the equities industry or markets have kind of, you know, not really addressed for the longest time.
Yeah, I mean, I agree. I'll add some other pieces to the equation. But yeah, I generally think that the discussion happening in crypto is happening at a good time, because I think a somewhat similar, albeit different conversation is happening in the traditional asset space, which is that there's been an excess of private capital, which has led to a liquidity or illiquidity premium on private assets, which is just objectively not how the world should work. And I'm happy to argue that to my death. Um, and as a byproduct, there's an advantage for companies staying private. There's also natural advantages unrelated to valuation. Like ultimately, it's a nuisance to be public. You have to share information. You have to deal with certain regulations around what can be shared and what can't. You have to deal with stock holders that bother you 24/7. I mean, things that you see in crypto, but on a much grander scale. And so ultimately, being public is a trade-off, but the trade-off is not an obvious one to make when your valuation is poor or when you are public. So I think the trade-off today is not obvious for companies to make, and that's why you don't see any companies going public or very few. Um, but there are perverse incentives that this sets up. And this is a 10 plus year issue in the making, but the public markets are deeply unhealthy. In some ways, they're much more efficient than what they were 10 years ago, but in other ways, they're incredibly inefficient. And the ways that they're inefficient are negative for creating fundamental outcomes. And so, by that, I mean you don't have as much long term, sophisticated capital in public equity markets anymore. And part of that is due to a lack of opportunities relative to an excess of capital attempting to seek these opportunities, and that if there's excess capital in the markets, it can't play a valuation game. Because ultimately there's a certain amount of capital that covers all the fair value, and then beyond that, you're playing a number of different games. And so I guess my point is that being a long-term fundamental investor has been the wrong investment strategy in public equity markets for the past 10 years relative to like playing pod shop games, quants, like playing shorter term fundamental catalyst games. Um, and it's also created disincentives for companies going public. Like the one that's obvious today that you see with companies that are IPOing and have IPO'd for the past 5 years is that they IPO at some ridiculous valuation. Figma, for example, they go down 80% and they have a massive employee issue. Their employees thought they were rich at the top and now think they're poor down below. Maybe you have to restructure their compensation package. And it's like very detrimental to the momentum and morale of the team, which then reflects in lower productivity for the team. And the same is also true on the opposite side, where if a company trades at too high at the valuation, then the team will sell their equity and move on. And then you have a company that is generally full of worse talent as a byproduct. And these issues have been very apparent in crypto markets, but have become quite apparent in public equity markets. But I think ultimately the long term equilibrium is solved by pushing more public or pushing more assets into the public market, because the demand side for buying these assets, it's harder to really move around. But ultimately, like there is a limited amount of companies that are public. And so if you flood the market with public companies, then you create more of an equilibrium between the demand for investing in companies versus the supply. And in theory, that should force people to focus more on fundamentals, and that dampens some of this like irrational volatility that you would otherwise see. So I don't know. That's a long ramble. That's like somewhat adjacent to what you initially mentioned. But I think it all comes hand in hand, which is we've been in a capital abundant society. Like you look at multiples on valuations versus GDP, and it's very clear that these are aggressively priced, and partially due to the fact that they have higher margins than history and in some cases higher growth rates. But I think what it suggests is an overvaluation across asset classes that's partially due to the composition of public versus private capital, as well as public versus private companies. And so these problems are all going to get fixed one way or another, whether it's the prices come down and therefore there's less capital to allocate, or more capital moves to public markets, more equities launch publicly, and then you have kind of right sizing. But ultimately, I think it all comes down to what are the factors that regulation can impact to equilibrate these markets. And I think one of the easiest ones is to reduce the cost of being public.
Yeah, I guess one thing that I was thinking while you were saying the last few things is, I guess in crypto, if there's one positive thing we can draw, is that generally protocols go public like much earlier in their life cycle, in the sense that they don't face that choice between like the traditional equity world of going public, but rather you have a bunch of projects that have their token live when they're still considered like a startup, if that makes sense. So I just wonder, like, what are the dynamics like they're like, do you think that is like positive? For instance, on MetaDAO, like that is for me one of the clearest examples where like a startup raises I don't know, 50K or 100K to like, do their thing, and they have their token live on day one, practically, when they're still like a pre-seed project. Like I'm curious if that accelerates that, like that thing you were talking about earlier, if that makes sense.
I'll preface by saying that I think that a lot of companies are better off being private early on in their company formation, whereas there's only a small handful of companies that benefit from being public early on. And like to my point on price volatility should be driven by fundamentals. And so the earlier stage you are, the more volatile your equity should trade. And so it's hard to build a company when your company's value is publicly listed and trading in like 1,000% range. So that's my initial inclination on should companies go public early on. It's just if you don't have to, it's like if you can raise private capital and get to a more sustainable period where the implied volatility of your business is sufficiently low to justify being in public markets, then it makes sense to do so. And so some businesses can, like small businesses that get to a very sustainable level, but on a low revenue base, can probably be public at a small market cap, whereas companies that are attempting to achieve a large outcome where there's not much to show today, in some cases, probably shouldn't be public. But there are also benefits to being public as a small company that is growing rapidly. So one is uh, discovery essentially. Ultimately, if there's a public ticker, there's going to be investors that look at it. And so if you're a financial services business and you want to generate user activity and you think that your users are also potentially investors, that's a great way to get inbound. And also like if your users own your equity and your equity goes up in value, then they have more capital spent on the platform. That work great for hyperliquid. So there are all these cases that benefit early companies, but there are also the obvious downsides. Um, and so I think that the benefit that public markets have when they work efficiently is that they have faster lead or feedback loops to private markets. Like, for example, everybody's known that private equity and private credit have been in that space since 2020, 2021, but there really hasn't been much carnage until 3 to 4 years later. Um, Whereas in public equities, if something is going wrong, it tends to be priced in pretty quickly because there's money to make by kind of trading these shorter term moves. And so for a company that wants to find out if they're going on the right path for their product, if they have an instrument that trades efficiently relative to their fundamentals, that should be a pretty good way to figure out what you're doing right and what you're doing wrong. The caveat is that, like, as an early stage company, it's very hard to get efficient price discovery because there rationally shouldn't be that many people that are interested in speculating on your equity. Um, so I think there are certain situations where it makes sense. But in general, like if you have limited access to capital and you think you have a great idea, and ultimately the public market should be able to give you more access to capital than private markets, somewhat by definition, then in some cases your only option is to go public. And that's where I see in many cases MetaDAO projects going. It's early stage companies and emerging markets that need capital to grow their business, and without capital their business is dead. And so the alternative, the trade-off is obvious. um, but simultaneously I think that's somewhat of a niche market today. But I also think that there's counter positioning value in today's market where a lot of tokens, you don't know what you get when you invest in them. Whereas in MetaDAO, it's created pretty strong investor protections. And so, as a company that is potentially looking to get early users or draw attention to itself, I think that MetaDAO is really valuable. Yeah, because there are now several cases that have proven the efficacy of the model, and people are acutely aware of MetaDAO. Like when I talk to investors, there just aren't that many tokens that are launching the market. And one of the only places that I see high quality, favorable risk reward ratios on early stage tokens is coming from MetaDAO. And so I think that like can compound on itself. But I also don't want to like muddy the conversation by focusing specifically on MetaDAO. I think it's a good example of ways that early stage companies can be public in some capacity and have benefits doing so. But it's just to say the whole topic's quite nuanced, and I think right in the middle as far as I understand why certain people believe that early stage companies shouldn't be public, and I also understand why certain early stage companies should be public just because as a necessity it makes sense for the business. And the last thing that I'll mention is just on decentralization as well as global distribution, like one problem that I don't think can be solved by regulation is creating a global shareholder base. Ultimately, like in order to create KYC, you need to be able to accept identification from specific countries. And I recognize that from like a capital weighted perspective, most of the capital is in developed countries that shouldn't have issue performing KYC. But then you get in the question of, okay, do I have foreign holders? Does this bring on more disclosure requirements for me? And then also, like, if I'm creating a decentralized protocol, do I want a security or do I want to have some type of like ownership token? So like the example I'll give you here is P2P, the upcoming MetaDAO launch, where they're building a decentralized peer-to-peer off-ramp network. It's fully KYC'd and regulatory compliant, but you could imagine that if they're operating in certain jurisdictions, regulation will be quite detrimental to them. And so if you can credibly decentralize early on, then you can enter some of these jurisdictions that if you had a public equity would probably invite like regulatory action against the founders of the company. So I think there's also a bit of like a reg arb opportunity there as well. But I know I've rambled for a bit. Those are just some of my thoughts on early stage companies being public.
Yeah, I like a lot of the thoughts now. I think I'll echo some of them, and I think like the nuance, it's a nuanced topic 1000%. I think there are, even in the absence of, reasons that companies stay private for longer in kind of the current regime, there are still, reasons maybe a private company would want to be private, even if they weren't getting, an inflated valuation in private markets or other, benefits today that might not be sort of like naturally founded. I do see I think the point you made kind of around like, consumer advocacy for a product is a pretty strong example for, a smaller or like earlier business, maybe raising capital publicly from perhaps users or consumers of that technology or product. Like they can maybe see, or they have a view of what that product means to them, or they could see the next 5-10 years out of, hey, I see this being beneficial as a product in the marketplace, and they'd be advocates for the product. And, they kind of maybe speak to the stock. And if the stock goes up, then they're happy about it and they're happy to continue advocating for it. That maybe doesn't make sense for like a chemical plant in the middle of nowhere in Argentina. So of course there's nuance to like types of businesses and who they might market to and who makes sense as an investor to those businesses. So I think that makes a ton of sense. I think the point you make on the global shareholder point is really interesting as well, because I think even the, like the brokerage platforms or maybe like the exchanges sort of see this opportunity in different ways as well. Like, if you think of crypto perps exchanges today, it's like has been this ongoing thing of like, well, if we can remain, non KYC for as long as possible, then that sort of opens us up to this, global potential user base that, can trade on the platform. We don't have to be concerned about, restricting certain forms of, I mean, maybe you are effectively restricting some usage or capital just based on the fact that you're not regulated in that sense, but there's maybe benefits in the other direction. But I see as well, like when you look to, the Robinhoods, the Coinbases, and these businesses that are looking to like tokenize stocks and then potentially bypass, trading regulations or, equity trading regulations in various countries by just sort of offering that service globally through a kind of tokenized equity platform. It's this reg arb is apparent in both directions, right? Of, if I want to launch something, like if I want to raise and launch an equity or like a token, me personally, it's like I could raise via something like MetaDAO and anyone around the world could invest in that token. But also if I'm the business considering how I make my money from trading or from issuing of assets, it's like I might consider how that impacts me in the future. If I expect more trading or economic value to come from these like more emerging markets over the next 20-30 years, I might be thinking about how do I get people from Singapore and Indonesia and India like access to trade, US equities or European equities. I feel like we're seeing that conversation happen like in disparate parts, which is interesting. It's not like just siloed to crypto or crypto companies, at least.
Yeah, I mean we're increasingly global market, and people should not have to think about investing solely in the assets within their country. I think that that's probably what's led the US equity markets to be so aggressively valued is because there's been so much focus on US markets, but ultimately there are a lot of other markets and market regimes across the world, and they're all equities or assets that have very different disclosure and requirements, but ultimately follow general characteristics of what an equity represents. And so, as a trader, investor, etc., they're all opportunity cost to one another. And there's nothing inherently that should stop one person, one part of the world from trading an asset. I mean, I have questions on whether you can be knowledgeable about companies nowhere near you that like you don't really have that much information on, but in general, I don't see any reason why these things shouldn't be accessible. I am a bit skeptical on the value of no KYC. Like my inclination, and I have a better sense of it on the AUM type businesses versus the trading businesses, but I really think that if you were to do an analysis around the market opportunity for non KYC capital, it's mostly criminals. Like, if we're being very honest about it, there's billions of dollars in crypto that moves around DeFi protocols from people that some know, some don't. But the reason they don't KYC is probably because they're doing something nefarious. Either they're not paying taxes, the money itself is gray, etc. Like, I acknowledge that certain KYC regimes are difficult to participate in, and depending on who your KYC provider is, I may not want to just give them my social security number, etc. But like ultimately, like there are very good KYC providers. So I think as long as you can find one that works well and has international access, then so there's really not much of a market opportunity that you're opening yourself up to by being non KYC, other than the current market today, which I'd imagine is not going to grow that materially. I think the much larger opportunity is on the KYC part.
I agree that like probably if you KYC, you attract more capitalized players or sophisticated participants to your platform. But I do disagree that everything like needs to be KYC. I do think there's value to permissionless systems. Like I wouldn't want, for instance, to KYC to deposit into Camino, and I'm not like a criminal, right? So I don't think that necessarily if you're permissionless and you're not KYC, you're like incentivizing criminal activity. I think there are other ways like through on-chain activity to kind of detect like funds that have like traceability of like criminal intent or things like that. So I do think the value of permissionless systems is really important, and I wouldn't want to see a world where the entirety of DeFi like just defaults to KYC only. Um, but yeah, happy to push back on that.
I agree. I mean, I definitely share the ethos of our industry, and perhaps my view at this point is just one of being jaded from the past 5 to 10 years. Um, but simultaneously, my view is that a lot of this is form factor issue as opposed to like does it or does it not make sense at a very high level. And that's just to say like I think that Camino's product would be negatively impacted if every time I wanted to use it, I had to submit a KYC form. But like for example, if I had an NFT, not this isn't able to be done today because KYC isn't transferable, which is kind of my point that I alluded to earlier. But if I did NFT that said that I KYC'd with Persona, like one of the relevant KYC companies in the US, and that was generally accepted by Camino, I would have no problem with that, especially if there was like a zero knowledge component that conferred the fact that my KYC was done in certain conditions. And like I agree idealistically, like people should be able to move their money around in a permissionless manner. And I don't want to go down this rabbit hole too much because I think it's probably not too related to the conversation. But my pushback on why KYC and generally regulation around money movement is a good thing is partially one based on weapons and technology, and that like ultimately where you're solving for is this corner case of terrorism. Like there are many other things that are separate to terrorism that KYC is involved in, but what it really comes down to is if you can allow an individual to accumulate a lot of capital that's going to do something very bad with that capital, that is a bad outcome for society. And like you look at the trend of weapons, like they are becoming increasingly powerful for individuals. And so today, not everybody has nukes, but like the number of people who have access to a nuke is increasing. And that same logic can be applied to a lot of different weapons. And so if technology continues to move in the direction of allowing the individual to have access to create a lot of harm, the policing of money probably has to increase as well. Otherwise, you will have this tail outcome where some crazy person accumulates a lot of capital and ends the world. So like that's my pushback to like why KYC, albeit like it limits some access, is a necessity within the current society. Is just the tail case of allowing a terrorist to accumulate too much money is so detrimental that I'm willing to reduce the value of certain technologies to prevent that outcome. But besides that, like I'm fully aligned. I've grown more uh, in favor of the argument that like we have a society that we need to protect, and KYC is one of the aspects that can protect it.
Yeah. No, I broadly agree, and I'll move on from this topic. The one thing I'll say is that there tends to be this slippery slope where, like, in the name of KYC and AML, like to prevent terrorism or whatnot, like regulators always, when they can, tend to like extend like their, like they always tend to go one step further than they need to, and like it tends to be ridiculous at times. For instance, I know a friend like was receiving like a Revolut payment like via crypto, and just like for $100 transaction or whatever, he had to like KYC to go through all like these forms, like these ridiculous like kind of like outreach of the government just for like money movement. Like I understand that it's like a trade-off between like accessibility and like national security. I don't know what you want to call it, but I like, my point more broadly is that this never tends to like stay like where they needs to be. It always tends to be like outreach. Like when you give the regulators some power, they always want like more power and more power, and like that's kind of my fear. But yeah, we can switch topics.
Just last thing there, I agree, and I think that like KYC is most detrimental towards the low wealth retail participant. Like if you force an agenda where everybody has to KYC, um, ultimately like there is a fixed cost to perform KYC, and so if you're moving small amounts of money, which could be quite material for certain people, the percent cost on that is going to be much higher if you are in a KYC regime. And to your point, I don't think there's that much harm that could be done with $100. So I'm fully aligned on that side of things. So just wanted to add that as well.
Yeah, I think fair points on both sides. We see current governments grappling with these topics, and there's obviously lots of pushback when you see things like, if the UK government imposes a CBDC and you have strict limits on how much of that currency you can hold in a bank account and other things. It's like, to your point, Noah, there's more potential risk for smaller wealth holders than larger wealth holders, when in reality the goal is to ideally prevent, like you mentioned, this tail risk of some individual from obtaining a bunch of wealth and then using that wealth in ways that is a net negative to society, for example. If we jump along then maybe and talk kind of final topic for the day around, I think we've stepped through some interesting things, like talking through the guidance, this like where regulation has come in relation to various types of digital assets and like the certain types of like asset types that we've kind of worked with. I think maybe it's relevant to discuss, like, I think in the past year or so, we've seen actually a lot of different directions now that the industry and like teams within the industry and tokens within the industry are starting to take. So some of those have been, you kind of have effectively a worthless public token for some kind of protocol, and then they get acquired and then the token goes to zero. Obviously, that was a positive outcome for any of the teams that did that. They got acquired, maybe for a nice sum, and they're probably also still working for a nice salary now that they've been acquired. Um, But for anyone who was a token holder, they obviously got a poor outcome. We've seen recently, like across with the ACX token, they've put out a temp check. I don't know if it's gotten any further than this since the post, but around doing a token conversion to a private C Corp equity. So effectively saying like the token is the equity. We're going to buy out any remaining tokens if no one wants to, whoever doesn't want to convert to the private equity, we'll buy you out. We're just going to become a private company and continue operating. And then we've seen like the continuation of on-chain things, and there's really like been, I would say, two directions really at this point. It's like you either say, hey, we're doing a token and we're just going to redirect all of the revenue or most of the revenue that comes on chain directly at the token, and that's sort of like our way of having good faith from the market in that this is like effectively our equity. Or you've had models similar to the MetaDAO approach where you kind of like lock down the IP and maybe the ownership of the funds that the business or the company kind of holds underneath the token itself via voting rights. I'm curious, like, if you guys have a view on, is there an ideal outcome, or is this just a nuanced thing and we're going to end up with, there will be different approaches that make sense for different types of businesses? And if so, are we kind of at maybe some of the end states of some of those, or is there a ways to go? Like, is the MetaDAO model and even maybe the cross ACX outcome is that like, we can't really effectively do tokenized equity on chain today, and so therefore we're sort of like at these half measures for now.
There's a lot to touch on. I think we're definitely not at an end state. I think that to me is apparent. To your point, the regulatory regime to have tokenized equities work is not clear. I think you can tokenize companies and have secondary markets because they are rate listed and on the NYSE and NASDAQ. And you've seen that occur, but you really haven't seen too many companies tokenize their equities and trade with any liquidity. There were several attempts like years ago, but none of them really did much. And I think that teams today that are contemplating doing so wouldn't know where to start because there isn't a playbook for it. But I think we all kind of know that based on the direction of regulation, there probably will be in a couple of years. And so if I had a portfolio company asking me like, I want to potentially tokenize my equity, I would token today, I wouldn't have an answer for them other than probably don't make anything that you can't undo occur, because ultimately things are changing and you're in this period of time where it's not clear what you should do. So that's like one piece. The second is there are certain things that are beneficial for businesses today, even acknowledging that there isn't a good end state. So for example, if your token is a detriment to your business, taking it private makes a lot of sense, especially if the valuation of the token is sufficiently low where the cost to take it private is not material. So I can understand that aspect of things. I think Felipe, my partner, he made a good point, which I had not previously thought about, where there is some issue here. Like there is this corner case of team FUDs their token, or like makes it obvious that there's no value associated with token. Token goes down sufficiently low, and then they say, we're gonna buy ourselves out at a 25% premium to the market. That's obviously not what Accrual did, but it's just to say, like, you could imagine an ethical team doing the exact same thing Accrual did, but like for this motivation. So I think we need to be careful about kind of setting standards for taking companies private, because it creates some odd incentives. But the last thing I'll say here, which I don't know, I think is well understood, but I'm just going to mention it. Like ultimately what teams do by when they go private, like in the case of, we got acquired, our token's worth nothing, it's purely an ethics problem. Like, don't get me wrong, there are certain situations where you as a founder have priced equity, you launch a token. If you confer any value to that token when you go private, your equity holders can sue you because you did something that's against their fiduciary duty. But putting that aside, your choice to rug the token is purely that of ethical and morality boundaries. In the same way that, like, if you look at traditional markets, it has long been a playbook to be a shark. Like in private credit, you see lender on lender violence, where like you take the collateral from one entity and put it into another. And so now the people that have lent to one entity are screwed if that entity can no longer pay its loans. And so it's just to say, like, you can operate within the legal system to do things that are unethical. And the same thing occurs in all markets. And I think that crypto's generally had a morality problem where it's subject to adverse selection. And so teams, especially when they see other teams acting unethically, feel that they can get away with it. And so I do think that's a problem. And I think that's why we've seen a lot of these M&A deals go the way that they have. Um, but on the other side of things, like, there are at least one or two tokens that were acquired that made material representations to investors in the tokens, and those token holders can sue the founders of the team because they did something that is like very clearly financial fraud. Um, so it's all to say there's a lot going on. I think it's case by case, but ultimately, I think it's best for everybody to act ethically and do what's best for your business, but not sacrifice any of your stakeholders in order to do what's best for your business.
Yeah, I probably agree with those points. Like, I know, Danny, you have been saying this, like, maybe we just converge to a state where it's all equity and we just tokenize that equity and that equity comes on chain. Because at the end of the day, the lines are blurring as we advance in regulation between what a token and what an equity gives you. I think the one differentiating factor for tokens is what we were talking about earlier about global expandability and global accessibility, in the sense that if you issue equity, by definition, you're doing that in a certain jurisdiction. Whereas if you issue a token, you kind of have like this global accessibility, or you go global from day one, and anyone can like underwrite and invest in your product or your business. So I think that's one potential difference and potential advantage. I'm also curious if there are any differences between the ways teams based in the US versus offshore have been handling this. Um, yeah, because a lot of the issues that we have seen in the industry, like over the past few years, have been from US based teams not knowing how to act, whereas generally like Asian based teams, for instance, have been able to much better like direct value to the token and have provide greater clarity around token value accrual. Like Hype, Jupe are examples for me that stand out as like favorable token structures that didn't have the burden of having to be subject to US regulations. But yeah, those would be my thoughts.
I think you make a good point on non-US companies versus US companies. I think part of that we're all aware is a function of the previous administration and the negative regulatory regime, making it so that anybody in the US, I mean, you can't really do anything during that regime without instigating some type of enforcement action. So like naturally that was restrictive. Um, that being said, things are changing. So I imagine that companies are going to re-domicile to the US from offshore. I think like there are many companies within the Solana ecosystem that are exploring that. The main issue has just been understanding how to deal with the taxation during their transferability. Yeah. But otherwise, I expect that to occur. I think it's in the US's best interest to make tax money from having companies be registered within it. And the other thing that I'll mention is that like there is a good reason why equities in the US trade at a premium to equities around the world. And putting aside like whether the US is more productive, etc., the rule of law in the US is much stronger elsewhere. And like there is a demonstrated risk premium in many countries. And so there is a benefit to going public in the US. And ultimately, like a lot of capital markets seek out US access or US assets for that reason, is because the rule of law is so strong. And so the claim on ownership is strong, and therefore the risk premium to owning it is sufficiently low. And so you get this valuation bump. And so I think founders will be incentivized to go public in the US, because if you go public in, XYZ country, you're just not going to trade as well. Naturally, you need the regulatory regime to be in place to do so. But like the example I'll give, not related to Jupiter or Hype, but the issue with attempting to convey an asset as having equity or ownership, but it not actually being registered equity, is that you are kind of at the whim of the founders. And like you can create these complex legal structures in order to limit the tail cases of founders not honoring their intent. But ultimately, there will always be a risk premium associated with, will this founder do what they have said they're going to do? And I think that people in general are much less likely to act unethically when they know that there is a court system that will take care of them if they act unethically. And so within the US, that is very defined. If you register offshore in XYZ jurisdiction, that's less the case. And so I actually do think that a lot more companies are going to register their tokenized equities in the US versus outside of it. But to your point, like it does limit global accessibility, but I think there are ways to get around that. I'm not as knowledgeable around how foreign holders of US assets actually get access to them. I don't think it's that big of a burden for a lot of developed markets. But I also have seen like several workarounds where like you can create an SPV within like a public cap table that then launches a token, and there's certain assumptions around the value of that token and its ability to like get access to the equity held in the SPV. But like these things are legal. They're like regulatory complex and probably should lead to these tokens trading at discounts to like the tokenized equity. But if someone was optimizing for getting global accessibility from day one, they could carve out a portion of their cap table to kind of play the more regulatory arbitrage game. Um, so I don't know. I hear you, and like I'm partially projecting what the world may look like that makes some of my views make sense, but that's my sense of the direction market's going.
No, I totally agree with that. I think there's a world where we see like tokenized equity issuers like X stocks kind of fulfill that function, where they already kind of do this with US equity, they wrap it, put it as a Swiss tracker certificate and allow it anyone in the world to invest in like X Tesla or X coin or whatever it may be. I think the only caveat there is that probably like non-US investors won't be able to like vote on things or whatever. But at the end of the day, I don't think these people really want to do that. Like as long as you give like global accessibility and allow them to track 101 the value of the token, I don't think that should be much of an issue.
Yeah, and maybe the point to be made there as well is, I would imagine if you are a wealthy enough individual, regardless of which country you're from, there is probably a means for you to invest a meaningful sum into into a US equity or a European equity, and then cast your voting rights if you hold a meaningful number of shares. Whereas, if you're buying $100 worth of Tesla, like your vote did not going to be so crass as to say your vote didn't matter, but like effectively, it's not like the voting rights of the $100 shareholder are going to matter so much in choosing the next board, for example, of a multi-billion-dollar or trillion-dollar company. So yeah, I think I agree with you on that point, Carlos, and I think to Noah as well. Like I would probably generally agree. Like I think I have optimism, largely speaking, on both sides of this coin. One in the sense that I think like financial businesses, and maybe it's like exchanges and brokerages, generally speaking, both within TradFi but also within crypto, are like becoming more attuned to this idea of having like global access to markets. Obviously, there's structures today that enable that. Like if you're within the U.S., you can purchase ADRs that maybe represent Chinese companies or European companies, and there's kind of like ways to do it. Maybe there are trade-offs and drawbacks to some of those that can be more directly or better addressed by like just tokenizing an equity and making that more sort of freely tradable by anyone globally or most people globally, depending on sort of the KYC regime that we have to fall into there. But it does feel like, generally speaking, like the direction of travel is to the positive, both from an access perspective and also from like being able, like both from an access perspective of like within country to external countries, but also from like external country to any other country. And I see that trend just continuing, unless I don't know. I feel like you would have to see, global tensions heat up significantly, like across the board, versus kind of the more specific conflicts that we see, like maybe U.S.-Iran conflicts prevent some, maybe I won't hold a bunch of equities in Iranian companies, but I can, you can buy shares of Chinese companies, no problem, despite the sort of, the 1v1, so to speak, that those two countries have at the moment within kind of the geopolitical spheres. So I remain positive across the board. I think, Carlos, maybe to the last point around this trade-off in the commodities and kind of securities space is that I expect that we probably do continue to see some things will end up looking more like these digital commodities, and they may like live on for quite a while, and some things may trend into this digital securities bucket. But I think maybe just to tie it back, that you have to have, by necessity, probably completely different expectations in how you approach the valuation of these assets and maybe what their long-term trajectories look like, from, to be a long-term holder of one or the other is probably a different question. And certainly in the conversations we had around, like, does it even make sense within US equities markets to be like a long-term holder versus like a trader of some sort, or to play a certain type of game? Certainly the games will be different, and whether or not you're maybe a long-term holder of those things is different as well, I would imagine.
Yeah, I will say this is the only caveat to my tokenized equity spiel, is that I think I'm willing to bet that the world becomes more multipolar, less globalist, and so like the regulatory regime may become more adverse for people to operate as global citizens, in which case creating offshore like ownership structures as opposed to registering within the US could make a lot of sense. Um, so I think that's like the pushback to all these ideas of using US regulation to tokenize equities and kind of move off capital markets. So a global base, but with the US rule of law, it requires the US rule of law to continue to proliferate and work effectively, which I think it will continue to. But I think that given that we're all in crypto, and I think there is a bit of a libertarian bias that we all share to some extent, like I am open to the alternative and making sure that we have globally accessible money via permissionless neutral rails should be something that we continue to optimize for. But simultaneously to trying to allow for crypto to exist within the global regulatory apparatus.
Yeah, I think that's a fair point. Maybe to close things out, I think I would maybe express the view that it's I think both can be true in the future, in the sense that I think when you look at a lot of trends, generally speaking, like certain aspects of those trends can become more extreme, maybe at the tails or the fringes, but then, the median can still bulge up, in a sense that, like, maybe global access, generally speaking, becomes a much larger thing kind of around the world as it relates to, equity ownership or token holders. But, maybe certain caveats prevent, high concentration of, people from Singapore owning assets in Russia, for example. But they might be able to have more access on a smaller scale, generally speaking. So certainly agree with you. I think both could be true. One side could be more true than the other, and we'll have to see. Usually there's a lot of nuance in the statistical realm in terms of the median versus the average versus the tails. And that's where a lot of conversations get caught up, I think, on social media today. So Carlos, Noah, this was a great conversation today. I was glad I could have you both on and we could dive deeper into this topic, which I think has been top of mind for years now at this point, but certainly top of mind for the entire industry for the past like 6 to 12 months. It's been very polarizing. So great to have you on, and I'm hopeful that we can maybe continue this conversation, a few months out, maybe a year out from now, in maybe even a more positive direction, depending on how things have played out.
Thanks for having me on. I enjoyed the conversation.
Yeah, it was really fun. No, I should come more often. Yeah.
Awesome. Thanks, guys. We'll make it a point to try to get Noah on more frequently, more topics. But for the listeners out there, we will catch you next time.